Hi, I'm Mal from the Money Study, bringing you another episode of our Take 10 Challenge and number 47. I'm going to talk about the tax issues for investors. The government always want their little share of your benefit. Before we kick off with it, there is my disclaimer: facts, figures, information. It is not personal advice. Okay, so we're going to do some investing, but when you fill out application forms for any sort of investment, generally speaking, they'll ask who is obviously making the investment. Is it you? Is it you and your partner? Is it a company trying to invest? And there's all these different structures that can be used to purchase shares and so forth, purchase managed funds, purchase ETFs, and so it goes on. And depending on your own scenario, then some of these structures may or may not be useful to you. Now, most people starting out would simply be what they call a sole trader, meaning that's you. So it's just done in an individual personal name. Therefore, any earnings, any interest that it does, any dividends that it gets paid, any capital gains issues, all of it's taxed in your name. And so it's just added income to your current income, and therefore would get taxed at your normal marginal tax rate. So that's a sole trader. And as I say, that's how most people would do it. It's nice and simple, it's easy to do, and depending on your tax bracket, may or may not be a problem. There are, however, advantages if you do have a partner that, and even it could be a brother or a sister, it could be a partner, it doesn't necessarily have to be your spouse or de facto partner, but it could be just a partner. And the idea is with a partnership is the fact that the interest and the dividends and the tax liabilities can indeed be shared. So you just imagine that you and your partner, and you all of a sudden get some dividends. Those dividends would then be split between the two people. Now, of course, obviously people on lower incomes, on different lower tax brackets, pay less tax than someone on a high tax bracket. Then they receive these other income dividends and so forth. Now, remember, there's franking credits and so forth to be taken into consideration, but it can be sometimes advantageous, especially when we start talking about things like capital gains. So when we come to sell it, and we've made a big profit, the profit, obviously, in the hands of someone who's already got big income could be quite expensive, but the profit in someone who's perhaps even retired and doesn't have any taxable income, it could be a better situation. So setting up a partnership, and of course a partnership does not have to be 50-50, could be 80-20 or 90-10. I suggest if you're looking to do that sort of manipulation with your tax, it'd probably be prudent to talk to your accountant to really understand the best way to do this. Now, some people who are, generally speaking, investing a lot of money may indeed set themselves up as a company, because as we know, companies can be indeed taxed at a lower bracket than sole traders, than normal individuals, and there could be some tax advantages in that. Having said that, there's always usually a cost in running a company, so we've got to be careful of running costs in comparison to tax savings. You might want to buy your shares through your super fund, your self-managed super fund, your SMSF, in which case you can have a super fund where you have control over all of the investments, and you're thinking, okay, well, super funds only get taxed at 15%. That might be a nice way to do it, remembering, of course, that any monies in super is locked up until your preservation age. So we've got those problems, the general problems of super, if we do it through a self-managed super fund. Some people have family trusts, and the family trust owns the investment. And there are some advantages in doing that, where the money from the trust is then distributed to the people who are the beneficiaries of that trust, in which case there might be some teenage children or something on lower tax brackets to disperse the profits and so forth. So there's advantages in considering you and your partner and or family when we're looking at investing. But for most people, especially when we're starting out, just setting it up as a nice, simple, in your own name, generally speaking, is not too much of a problem. Because I say with each of these different structures, then there are different costs. Generally speaking, the cheapest one is you. That's easy, nice and easy. But if you're running things like a self-managed super fund or a company, of course, they have to do their own tax returns. And so you get to the situation where your accountant might like them, because not only is he doing your tax return, but he's doing the company tax return and or your self-managed super fund tax return, and he's doing all the compliance and the auditing of your self-managed super fund, and so it goes on. Every time you get a structure, there's compliance costs that are involved, and those numbers can certainly add up and eat into any, perhaps, generally speaking, any taxation benefit. Things like company can indeed protect you to a degree, not completely, but there are some benefits in company structures. So if things really go wrong, you don't lose your house as such. But even a lot of those things are now, the loopholes are being wound back. But I say, if you don't understand this business of liability, then talk to your accountant. We've already talked about taxation, but each one of those structures certainly has different tax rates, different way it's taxed, and so forth. So understanding which one suits you is certainly paramount before you make your decision there. And of course, when you finally decide to wind it up, if you're just in your own name, you just basically take your money out and cancel the account. Not so simple. If you've got it in like a self-managed super fund, to wind up a self-managed super fund can be sometimes more expensive than actually starting it, because it's got to do a final tax return, and so it goes on. Your accountant would like to do that. So structures, if it's something that you really believe is going to grow, you might indeed want to look at something a little bit more powerful perhaps, but of course there's no real drama in changing a structure down the track, except for the fact that if you change it from your name into a self-managed super fund, for instance, later on, then as you sell your investment to move it to the super fund, even though it's your super fund, you would indeed trigger a capital gain, and you'd have to pay capital gains tax to then get the money into your super fund. And even if you then became individual and then you wanted to go to a partner, then generally speaking, we've got issues regarding then of actually, because it's a change in ownership, it can indeed trigger capital gains. So generally speaking, better to sort this out up front. And so for most people, I say, if you really think this is just going to be a bit of fun on the side, a little benefit that's going to grow over time, a sole trader would probably be fine. But if you think it's something, we're really going to put a lot of focus into this, it's going to grow, and hopefully there's going to be some big money in it, and it's going to certainly cause us some tax issues, then for the sake of a few $100s or so, I would strongly suggest you go and talk to an accountant before you set it all up. Now, of course, it's not just the structure that can cause you problems. It does cause other issues and things along the way. So again, it all comes down, if you're going to do it as a partnership, understand, if you're both in the same tax bracket, then really not a lot of benefit, except for the fact that if it's, so let's imagine you're on 115,000 income currently, with the tax threshold at 120, you'd only have to earn another $5,000 and it'd push you into a higher marginal tax bracket. Whereas if you had a partner who was also still in the same tax bracket, but their income was only, say, like 80,000, they're $40,000 away from the next tax threshold. And so if the distributions from any benefits from our investments were moved to the partner who had a slightly less income, they wouldn't be pushed above the next tax bracket and so forth. Investment timeframes, as I suggested, if you are looking for a shorter term to get in and out within a few years and then perhaps move your money to super just before retirement, then I must admit I wouldn't be getting too excited about setting up some sort of complicated company structure or something like that if we then had to pull that money out to get it into super within a year or two due to all the issues with capital gains and all the compliance costs in closing it up and so forth. Now, there's something you really got to understand with this capital gains business. Now, capital gain is exactly that. Our value, our capital has gone up from the time we bought it till the time we sell it. So if you've got a portfolio and it's worth 50,000 and then you, umpteen years later, you sell it for 100,000, your gain is $50,000. You've doubled your money. So it then comes down to how long have you had the investment for, as to how it is being taxed. Now, providing you've had the investment for longer than 12 months, so you've had the investment for more than a year, then any capital gain, so let's say you've made a $50,000 gain, instantly that gain is halved. So your $50,000 gain would literally become a $25,000 gain, and you only have to pay tax on the $25,000, not on 50. So long as you've had the investment for more than 12 months, the capital gain is indeed halved. Now, of course, if you're a partnership and the capital gain gets halved, and then that half is split between the two of you, we can see the benefits even further, that the taxes then being spread even further. But if I say you have got an investment and perhaps you just bought some shares in something that you really thought that, yes, there's going to be some news coming out on this shortly, there's going to be a quick, easy dollar to be made, and you buy it, and then you turn around and sell the same share within, under 12 months, then it's basically there is no halving of the gain. It's just treated like extra income for the year. So if you had made $50,000 under the 12 months, yep, you'd be paying tax on $50,000 to be added to your, say, $115,000 salary. Your income for the year would be $165,000. The bulk of it would be pushed into a new higher tax bracket. And you'd be paying, in that particular example, 37 cents on the dollar on the bulk of the 50,000. So all of a sudden we're losing, large amounts of money in taxation there. Now, the other issue you've got to consider with this capital gains business is the fact that if you do make a gain, the year that you make the gain, you have to pay the tax. It can't be deferred or pushed aside. Yep, if you have a capital gain, you've sold some investments, you've triggered a gain, yep, whatever that gain is and whatever the tax liability is, you have to pay it in that year. However, if you have a capital loss, so let's say you had a $50,000 investment, it fell to $40,000, that went backwards by 10, that's a capital loss. And you say you basically just got out, you thought this is not for me, I'm selling, and you do trigger a loss, then unfortunately, that loss is not subtracted from your taxable income. You can't subtract. Capital gains get added on to your income, but capital losses do not get subtracted from your income, this is the government getting the best of both worlds. What they do with the capital loss, they say, okay, yep, we'll park that capital loss until next time you make a capital gain, and then we'll subtract the gain for the loss from the gain, and then we'll just tax you on the difference. So you could have a loss, you could sell some shares at a loss, get no tax benefits from it, because it just sits there and sits there and sits there, and it might be 20 years later that you finally sell another investment where you've made a gain, and instead of having to pay the full tax on it, you've carried forward that loss, and you can subtract those losses from the gains, and you just pay the tax on the difference. So you've got to be careful. I get some people who will sell their losers, or it's usually the other way around. What they do is they think, oh, these things have made a lot of money, I'm going to sell those, and I'm going to wait for those other ones which have gone backwards. I'll wait for them to bounce back. They'll come back eventually. So you sell the ones that made all the profit, you trigger a capital gain, you have to pay tax on the gain in the year you sold those shares. You've now got some other shares which are a bit of a dog, they've gone backwards, you've lost money, you're still sitting on them, and eventually you finally give up and you decide to sell them. Now, because you now have no other investments, that capital loss will sit there, you'll get no taxation benefit from it, and if you've got nothing else to sell in the future for a gain, that capital loss just disappears down the gurgler. So if you're ever going to sell different shares at different times, ideally from a tax perspective, now of course there may be reasons why you want to sell some shares and not others at certain times, but if from a pure tax perspective, ideally you sell your losers first to trigger the loss, and then later on you sell the ones that have made the gain, so you've now got a loss to offset the gain. And now, of course, if you sell them all together in the same year, yep, the losses will be taken from the gains and you just pay the difference, okay? But if you're going to do them across different years, then generally speaking, do the losses first so that later on when you sell the ones with the gain, you've got some losses to subtract from it. Now, anytime you've got investments, yep, it's taxable income. It's going to be added to your taxable income, and we've kept to keep track of it. Now, a lot of these things like shares and so forth automatically upload these days because you're giving your tax file number to the people who you're buying the shares through, and it uploads onto your MyGov, and a lot of it's automatically done for you. The franking credits are all shown, and so it goes on. So it's getting a lot easier than it used to be. But there are some catches here, some problems, especially for later on when you come to sell them, especially if you're doing what's called dividend reinvestment. You see, some companies will pay you your dividend, you get a profit, you get the dividend paid to you, might be every 6 months, might be once every 12 months, but you get this dividend paid to you as cash. Okay, that is an income, you've got to pay tax on it. Take away the franking credit, and so it goes on. We've talked about that in a previous session. But some companies will allow you to do what's called a dividend reinvestment, meaning that instead of getting the dividend paid to you as cash, they literally just give you more shares in the company. So you're actually building your portfolio by the dividends buying more shares. Now that can be an excellent way to continue to build your portfolio. If you don't need the dividends, we can always spend it of course, but if we don't need the dividends, then by having them reinvested into more shares, our wealth is growing and growing and growing. The problem we have, of course, is that when we come to sell, then we have bought shares originally, but we may have been effectively buying shares in the same company every 6 months with our dividend reinvestment. So when we come to sell and we're trying to work out our capital gain, then we've got the original shares at, let's say, $10. We sell them for 20, the gain was $10. But if our $10 shares went up to $12 in the in-between period of time, we got a dividend reinvestment, so we're now buying shares at $12. When we sell those, the capital gain is the difference between the $20 sale price and the $12 purchase price. We might have got some more at $14.27. We've got some more at $16.80 and some more at $18.01. Each one has to be subtracted from the sale price of the 20, and each of those different capital gains, we have to work out what the gain is. So this gets messy, as you can obviously understand. So keeping some sort of a spreadsheet and keeping all of your annual statements, keeping track of when you bought them, what you bought them for, and how many you got, is pretty critical. I had a lady just the other day, had shares for 20 years and had absolutely no paperwork. And she just wanted to sell them. I mean, it was only, $20,000 worth of shares. But when she comes to do her tax return for the year, where she's selling them, it's going to ask her, what is your capital gain? And she's got to go back and, in theory, look at every single time she got dividends paid and reinvested as to how many shares she got at what price to calculate. This can be a nightmare. And of course, a lot of people just hand it across to their accountant. But the accountant's got to go back onto the website to find out, what the dividend payment was, what the percentage was, what was the share price. This is time consuming. Now, some accountants will do like a guesstimate, and they'll basically say, well, okay, we can't get the information. This is what we believe it is, putting the pressure back on the ATO. Have the ATO really got time to sit down and calculate whether your accountant is all right just for the time being? So it's a case of, very, very tricky. So keep good records. So I started off the page with keep good records. I'm finishing off with keep good records. And we'll talk about this in upcoming sessions, but understand every time you buy and sell, there's a cost. That's an expense that can be deducted, but usually that's in the broker report. But every time you buy and sell a share, you are triggering capital gains style issues for you to understand. Whew, there's always something to make it harder. Look forward to you to join me on another session.